Hello, everyone, and welcome back to another episode of the Isn't That Rich podcast. Today, we have on Chief Mortgage Officer John Streuter, and he is going to give us a mortgage market update, which is one of my favorite things to talk about. I love to talk about the rates. I love to talk about the housing market. We've got some fun questions coming up. So, John, welcome back. I know you love to be on the pod.
I love to do the podcast. I love to talk about the mortgage market. So, interesting topic.
Yeah.
And a good time for it.
Definitely. So what are you seeing kind of going on in the new year with the mortgage world?
Well, that's the big question that everybody asks is where are rates and what are they going to do? So right now we're still seeing rates up, or rates high, but they are down from where they were last year. So we're seeing market rates in the mid sixes to mid sevens, depending on what loan size, your credit score, and a couple other term, like 15 years, generally cheaper than 30 years. So depending on those factors, we're seeing anywhere from mid sixes to mid sevens. FHA tends to be a popular product right now, and FHA is in the mid sixes as well. So
explain what FHA means.
FHA is Federal Housing Authority. So typically in the mortgage business, you talk in terms of conventional loans, which is your standard 15, 30, and 20-year fixed. And then you deal with government loans. Government loans are your FHA, USDA, and VA. VA is strictly for veterans. FHA, anybody can use that program. USDA is primarily for moderate to low income borrowers.
And why would somebody use those? What?
I'm not getting any sound in my, I'm just hearing myself in my headphones. There we go.
Yeah. Is it loud enough?
Yeah, it's plenty loud. Yep.
Director.
I can just tell I'm just
He's
hearing.
like, I'm not getting any sound. No. Okay, so you can just start that over. So what's an FHA loan for our viewers?
FHA is Federal Housing Authority, and that's under HUD, Housing and Urban Development. Sorry about that. FHA is a government loan program that's open to any borrowers. When you talk about mortgages, you talk in the context of generally conventional loans, which is your typical 15, 20, 30-year fixed rate, or government loans, which is your FHA, USDA, and VA. VA is strictly for veterans. FHA is open to anybody. It's a low down payment program, so that's why it's pretty favorable. And USDA is another it's zero down payment program, but it's for moderate to low income borrowers.
Okay. So different types of mortgages for different people.
Many types of different mortgages out there. So, we always encourage people, and we've said this on previous podcasts, to get with the mortgage lender at Farmers, and we'll guide you through that process and tell you what all products you can qualify for, and then give you some direction as to why we think one is better than another.
Great.
That's awesome. So you were talking a little bit about how the rates are around at 6, 7, or a little bit higher right now. Is now a good time to buy?
Right now can be a great time to buy. The problem that many people are having with buying is a shortage of inventory. Mm-hmm. And that's where the rate problem becomes more of an issue, because right now sellers, and I'll use myself as an example, I have a mortgage that's in the 3%. My wife, Tammy, would love to buy a new home and out in the country. She's kind of tired of staying in the neighborhood, but I'm not going to be interested in buying a new house at a higher price and a higher mortgage when we've paid down on this one and we have 3%. So that closes the inventory in the market, because then people who would buy our house don't have that opportunity. So we're seeing a lot of that. Typically in the mortgage market, you always have this top-down situation where people are always trying to work up to the next level house. And so the people that are here don't want to buy that higher home at a higher interest rate. So that middle market that doesn't allow first-time home buyers who are now ready to get out of a small home into a mid-size home because they now have a growing family. There's no inventory for them to buy. And so they can't sell their homes either. And so first-time buyers are either having to look at these high-priced homes that are for sale that are maybe new construction. There's no entry-level homes. So at each of those levels, we don't have the inventory that we need to keep that real estate cycle going. And that's where the problem is. So if you buy, you can always refinance your interest rate. So if you can find the right home, it's a great time to buy because refinancing is easy and inexpensive.
So do you feel like the cost of houses are lower because of the interest rate or higher? Is it not really
I think
changing?
they're still staying up, aren't they?
Cost of homes are staying up because of that lack of inventory.
Gotcha.
I can price my house higher because if somebody is desperate enough to buy a house, they're going to pay my price. If there was inventory, then I'd be having to compete with all those people that are out there, and so I'd have to
Supply and demand, John.
Supply and demand, exactly.
We're still dealing with it 4 years later from COVID.
An additional problem, because of the high interest rates and because of the high inflation cost, contractors that would normally in this type of market build spec homes to put homes into that inventory don't want to build spec homes because they can barely sell them for what it's costing them to build. So that's the other problem with this whole process is we don't have a lot of spec homes. Normally, in Marion in 1993, when we entered this kind of market, there was an explosion of spec homes.
People were just building them for...
People were buying them as fast as they could. You know, as soon as the foundation was up, people were making offers on the home. And we just don't have that right now because builders, you'll see construction going on, but it's all custom build where if you're willing to pay the price of lumber and you're financing it, then the cost is completely on you, the homeowner, and not the builder. The builder's just getting paid to build it.
I was laughing earlier because what do you always say? You marry the house, you date the rate. Is that what you say?
I didn't say
that.
That's so good.
You marry the mortgage, you date the rate.
But that's an interesting comment.
said
No,
that.
I didn't.
Okay, that's what's been going around the bank that John Streuter said this.
I love it. Hey, I'll take it.
He's like, yeah, that was me. I'm real witty.
still quoting you on that.
I'm that smart. That's a great comment. I'll start using that.
Yeah, but I do think it's a good statement because I think people that feel stuck in this market right now, it is like, I mean, there's never a guarantee that a rate's going to go down, but I mean, if you look at the history of the mortgage.
So right now we're seeing inflated rates because of the inflation. Where the common rate should be is in the 5% to 6% range for a healthy mortgage market.
Yes, we're not that far off.
Correct. When people are saying, hey, our rate's going to drop back down to 2s and 3s. No, they're not. The feds artificially kept the rates down at that level in order to encourage the economy. So the feds were doing things that were pushing rates down that level. They can't afford to do that anymore. And so that's another reason why rates went up. But if the feds decide to cut rates a couple of times later this year, we should hopefully see that 5% range up and maybe in the low 6s. And that'll definitely stimulate the economy, stimulate the housing industry. And if inflation comes down, then that should encourage contractors to start building those spec homes and putting some inventory in the market.
Do you think that when interest rates maybe go down, let's say 1% or whatever, down to 5%, does that mean that prices of homes are going to go up because people can then kind of,
there's not a direct correlation between interest rates and home prices.
Oh, okay.
There is an indirect relationship in the sense that as rates go down, that tends to cause buyers to want to buy because interest rates are down. And so now you have that supply and demand feature in the housing industry that causes house prices to go up, because the more buyers there are, the less supply there is, the higher the demand, more people are willing to pay. So there's not a direct correlation between that interest rate and that house price, but there is an indirect, because you find more people wanting to buy homes, and that increases the price.
Gotcha.
But if contractors get into this mix with spec homes, that'll help level out and keep prices down, because that will then put more in the supply and equal the demand. So we may not necessarily see a price increase if we can get some contractors to start building some spec homes to put into the inventory of buying.
We need some supply.
We need some supply.
We need supply.
Come on, people.
Go contractors.
But I get
listen.
it. I get
Yeah,
it.
makes
I've
sense.
been building, and I get it.
Exactly.
It's a lot of
You know.
drama to build a
You know.
house. People are like, oh, spec home here, spec home there, pop up, pop up.
And it's a lot of
the
cost.
tears, John. The
And-
tears.
And it's a lot of cost, because
Yeah.
one time you check something out, you may have checked out your cabinets and appliances and countertops early on and didn't buy them. And then 2 months later, you find out, wow, there's been a 10% increase in cost.
Oh, there was like a 30% increase on some of my
Yeah.
building material.
Yeah.
So, yeah.
So, John, what is your personal prediction for this year? How low do you think it's going to go?
Well,
Hello.
I-
Can you go?
I will use, I try to monitor different websites. I listen or read a column or publication called Mortgage Daily News that I get information from, and try to listen to different business shows to see what the Fed's going to do, because that's generally what's going to happen. There's no direct relationship to what the Fed does to mortgage rates. Again, it's that indirect relationship. So if the Fed drops the rates at least twice this year, and we're waiting for the Fed, they won't meet in January, they'll meet in February, so we're anticipating that they're going to talk about whether or not they're going to, they generally will say, we're looking at this in the future. The anticipation is they won't drop rates in the spring or the summer, that we may not see any rate cuts until fall. If we do get some rate cuts, it will likely bring mortgage rates down at that point. Again, it's not, if they cut 0.25%, you're not going to necessarily see mortgage rates drop 0.25%. You may actually see them drop 0.5 to 0.75%. Because what happens is what the Fed does affects the stock market. What the stock market does affects the bond market. And that's what mortgage rates are driven. They're they're driven by the Treasury bond market.
Okay, I didn't know that.
Yeah.
That's interesting.
So you've got that 3-jump issue. What the Fed does then affects the stock market. What the stock market does then affects the bond market. And the bond market is what drives mortgage rates.
Okay, I
So
didn't know that.
sometimes you may see the Fed cut it. Years ago, we would see the Fed cut rates, and mortgage rates actually went up, because there was a stimulation in people said, okay, we're going to reinvest in the stock market, which then caused bond prices to drop, which caused the yield on the bond to go up. And that's what drives the mortgage rate. So it's a very complicated system.
Sounds like I need to go to banker's school. Sign me up, Charlie.
No idea.
It's a very complicated system. The best thing that I can tell people is watch what they talk about with the 10-year Treasury. 10-year Treasury index is what you want to, if they say the yield is up, then that means mortgage rates are going up. If they say the yield is down, then the mortgage rates are going down.
Oh
So-
my
It's
Like Groundhog
gosh.
Day, but for
Yeah.
Treasury.
I feel like my eyes have been open to something new.
We'll get phone call when the Fed was last 2 years when the Fed was talking about increasing interest rates. People would call, I got to lock my rate in. The Fed's going to raise the rates tomorrow. Many times when the Fed raised the rate, we saw a short-term drop in mortgage rates.
Oh, snap.
And it took a while for that hop, skip, and a jump to happen.
The
for
indirect
mortgage ra-
relationship.
right,
Okay.
for rates to then start going up.
I guess I always
fascinating.
thought that the Fed rate was the directly, it wasn't this hop, skip, and a jump to the
Same.
stock market,
Yep.
to the bond market, to this. I didn't realize that. And I don't think most people know that.
No,
This
the
is a very
Fed-
good educational
What
piece.
the Fed rate does, the Fed rate is the rate that the federal government lends money to banks. And it's also the rate that the Fed pays. There's two different Fed rates. It's also the rate that they pay on overnight funds. So what we have on deposit, we get paid by the federal government on overnight funds. So there's two different rates there, but typically what they're talking about is the Fed lending rate, which is the rate that we pay to the federal government to borrow any money that we need to borrow. That does have a direct relationship with the prime rate. Prime rate then typically does follow exactly if the Feds go up 0.25%, the prime rate's going to go up 0.25%. Prime rate is directly tied to what you'll get on a commercial loan. So commercial loans are affected by what the Feds do.
So
But-
if I got on Google and I said, what's prime rate right now? And it was 7.5, and then
8.5.
Oh, gross. And someone came in and they're like, I want to buy this business and I need a loan for it. Are you going to say, I know you're not a commercial lender, but Mike Hopkins would say, okay, it's 8.5%.
Right now, we're kind of on a discount from prime rate because our cost of funds is fairly low. So we can be about 0.5 to 1% below prime rate.
Okay.
But prime rate is that guiding force
Or
on what
commercial loans.
determines commercial loans.
Okay.
Interesting.
So if you're buying a house, you need to look at the 10-year
10-year Treasury
Treasury
index is what you want to be watching.
and you can Google that.
You can.
Great.
You can.
I'm always like, how do we find out this information?
You can. There are different programs that you can jump on, different apps, I guess I should say, that you can look at. You can also, if you're watching the stock market, your stock market app, if you're watching certain stocks and bonds, you can plug in the 10-year Treasury and it'll follow that for you. So depending on what kind of app or news that you use, CNBC is one that will track that. Fox Business, you'll see that. Bloomberg is another good one to track rates and see what's going on with the rates.
So it's something I can put on my watch list, is what you're saying?
You can.
Like I can with other stocks. Like if I was following Pinterest as a stock, I could.
Correct.
But
Because the 10-year Treasury bond is actually an investment that you can invest in.
Oh,
Now, it's hard for an individual buyer to go that you need to get with your stock person and generally get some sort of, I forget what they call them, but it'll be a fund transaction that you buy that would put you into Treasury bonds.
wow.
I didn't know that.
We're learning a lot,
But
Jared.
it is an open market.
Watch out, we're going to take your job, John. We know about
Well-
the 10-year Treasury bond.
It's generally the 10-year Treasury. When the 10-year Treasury is exactly the federal government, when they want to print money, they're selling the 10-year Treasury and the 30-year Treasury bills out there. So that's what major stock organizations are buying, and that's for long-term investing. They want to get a stable rate over a long term. That's the type of product that they're buying.
Okay.
So you've talked a little bit about like prime rate, what a prime rate is. What is an ARM rate? Can you explain what that is?
An ARM rate is adjustable rate mortgage, and that is a flexible interest rate. So many times a borrower can get into the adjustable rate mortgage below what a fixed rate mortgage is. And generally you'll have a 3-year term, a 5-year term, a 7 or a 10-year term, or the different rates out there. And so that means that rate is locked in for 3 years, 5, 7, or 10, depending on the one that you choose, and then it's going to adjust after that. Some adjust on that same cycle. So a 3-3 means that it's going to be locked in for 3 years, and then it's going to adjust every 3 years. A 3-1 means that it's going to be locked in for 3 years, and then it's going to adjust on an annual basis after that. So the key is if you can get into a mortgage on an adjustable rate 1% or less than the fixed rate, 1% is a huge difference on a sizable mortgage. So that's when you should take a strong look at an adjustable rate mortgage, and then refinance if rates drop. Typically, adjustable rate mortgages perform better than fixed rate mortgages, but they have an up and down cycle. So every time your rate goes down, there's a chance that later on it's going to go up, and people don't like that flexibility they want a stable payment so that they know how much they're paying every month.
So there's just a little bit more of a risk with that rate?
Right. So it's back to that risk reward, to where you get a reward on the front end by taking a risk at a lower rate, but then you're risking on the back end that rate could go up.
So let's do this with numbers. If I got let's say I did a 3-1 arm, and I got it at 5%, and then 3 years goes by, and then it's time for it to adjust. Is it in the market's at 10%? Is my mortgage now 10%?
No, there's a cap. Each time the rate changes, there's a cap typically of 2%. And this is where
that still can be 2% is still a lot
This is where you really have to watch when you get into an adjustable rate mortgage. You have to see what are the caps going to be. If you can get into one with 1 and 5, that's great, because that means it's only going to change by 1% anytime that it changes, and it can't go up by more than 5% over the life of the loan. So that 5% interest rate that you talked about could never go over 10%.
Okay.
But the idea of paying 10% on your mortgage is like, well, I'm not going to.
Gosh.
I'm going to rent, I think.
The typical caps are 2 and 6, where it can change 2% every year, every change date, and 6% over the life of the loan. Now, what you have to be smart about, though, is a couple of different things. Is look at what the mortgage payment would be at the fixed rate and what the mortgage payment's going to be at the adjustable rate. If that adjustable rate is at least 1% less, then take a look at it. But what you should do is don't use the adjustable rate mortgage to make your payment more affordable. Use it to your advantage by paying what you should be paying at that fixed rate. Start prepaying your mortgage with that lower interest rate, so that when the rate changes, there's not as much of a jump because you're paying what that fixed rate was.
And you can put it on principal, right?
Right. It'll automatically reduce the principal. The other thing is know that you have an adjustable rate mortgage, and every year contact your lender and say, where are the fixed rates? Does it make sense for me to refinance?
If that does jump them like 2%, have you seen any people that are kind of like, I can't afford this anymore, and are having...
Hopefully, we're not seeing it.
Okay.
And hopefully we shouldn't see that, because what happened in 2008 was, and really 2006 to 2008, is a lot of lenders were putting people in adjustable rate mortgages to make it more affordable to them. They weren't basing it on the fixed rate. They were basing it on that lower adjustable rate. As rates started going up by 2008, that's when people said, I can't afford it. And my taxes are going up, my insurance is going up, and my rate's going up. I can't afford it. A good bank would have projected a higher interest rate. So the good banks back then would have plugged in a higher interest rate and said, can the customer afford it at the higher interest rate?
Okay.
The groups that weren't required to do that didn't do that and put people in bad mortgages. Today, the government requires you to do that. They have what's called a qualifying interest rate. So I have to qualify somebody at a higher rate. and say, okay, this is where your rate could be.
So even if they can afford like the 2% interest rate, you basically are saying you have to price them at maybe a 4 or a 5 to say at a fix to say, when this does adjust, if it doesn't, it probably will. You
Correct.
can still pay your bills.
Correct.
Oh.
And the other thing is it's good for us to project what the payment would be if it goes to the full highest amount. So in that situation, say it was 2% and they had a 6% cap. So we should have said, here's what your payment would be at 8%. Can you afford that? If they say absolutely not, then that adjustable rate mortgage isn't a good fit for them. It's not a good fit for everybody. It's you have to be financially sound. You have to be a good saver. You have to know what you're getting yourself into to get into an adjustable rate mortgage.
So the true pro tip is if you have an ARM rate, talk to your lender, see what the max number would be, and start paying that already.
Right. And it goes towards principal.
So it goes towards principal. So if your interest rate does go up 2%, you're already budgeting for it, you're already ready for it, and it's helping. So
correct.
I think this is a great question that people often talk about. How much does the rate need to drop for me to consider refinancing?
Fantastic question. Funny,
John wrote it.
waiting for you to ask that question, because that is the question that we get all the time. 1% is the target difference. So if rates drop and you can get into a rate 1% less than what you're paying right now, that's a perfect time to say, yes, I need to pull the trigger and refinance. But you always want to deal with a local community bank like Farmers that's going to do some calculations, because 1% on a $25,000 loan isn't that much. So at the point of only having $25,000 left on your mortgage, it may never drop enough for you to be worth paying closing costs to refinance that loan. However, the flip side is if I've got a $500,000 loan, it may be worth me refinancing at just 0.5%.
Oh, wow.
So 1% is the general goal line of this is when I need to be considering refinancing. But if you have a very high loan balance, as little as 0.5% can make a difference. And as you know, we've had situations, I'll comment on the situation I had myself. My first home in 1990 was at 10.125%. I'll never forget that interest rate. In 1993, I refinanced to 9.375 and just thought the world, it was all great and fantastic.
American dream.
Dropped my interest rate by 5/8%. That was fantastic. Between 93 and 95, I refinanced my house 3 more times. So between
you were ate up with that. Wow. That's all he thought about.
Between 1990 and 1998. I had a total of 5 different mortgages because I refinanced,
and now you're down to a 3.
And then in 2002, we bought a new home. Interest rates were at 5%, and I told my wife Tammy, I said, she was talking about a new house, and I said, I don't know, we've got a pretty good interest rate, and because in 98 to 2000, 2001, interest rates started climbing up again, and they were in the 6s and 7s. And then after 9/11, rates had dropped down to the 5s. And I said, if you're wanting to buy a new house, now's the time to pull the trigger. So we bought a house in 2003, and I've refinanced that house, I think, 4 times.
My gosh.
Just rates kept on going and going and going down. So
you've been in the business a while, and this is an election year.
Yes, it is.
Is there anything you can say to that, or does that ever have an effect on the mortgage market or any of these markets we've talked about today?
What it has an effect on is stagnation. Every time that there's been an election in the mortgage business, in the real estate business, we see stagnation because nobody wants to move thinking they're scared. They don't know what's going to happen or
they don't know which party's getting in there.
Correct. And so we see very little movement in interest rates.
Oh, okay.
And, but this year we may see some movement in interest rates because interest rates went so high. And obviously the administration that's in now is going to be encouraging the feds to push rates down. That's why we think rates will come down in fall, just in time for election.
So it could be in people's favor.
So it could be. So we'll see. We'll see. Generally, we see little to no rate changes in a presidential election cycle.
Interesting.
Yeah. So we talked about ARM rates. Let's talk a little bit about buy down rates.
Okay.
What's a buy down rate?
That's been a topic that's been coming up quite a bit now. And there's two different situations with buy down rates. You can buy down your own interest rate by paying points. People will say, well, what is points? Points is a term that is what we call discount points. So today, if an interest rate was 7.5%, you could possibly buy that down to 7.25 by paying 1 point. 1 point is equal to 1% of your loan amount. So if you have a $200,000 loan, you pay $2,000 to buy that rate down 0.25% to 7.25. The idea is if you're in that home for more than 5 years, during the first 5 years, your monthly payment is probably just going to save you enough to recapture that $2,000. After 5 years, you're going to continue to save that money. And on a 30-year loan, you could save 3 times what that $2,000 cost you. So I generally recommend to people to look at 5 years. Do you plan on staying in? So right now, I would tell people don't pay points because buying a house, you're probably going to refinance in less than 5 years. So there's really no reason to pay points. You'll never recoup that difference. The other buy down is a seller buy down, where the seller pays those points in order to buy your rate down. And they're not actually paying points. They're actually paying the difference between what you would have paid in interest at the full rate versus what you're going to pay at the discounted rate. So there's what they call a 2-1 buy down. There's a 3-2-1 buy down.
Gosh.
The bank has to do the
it's like I'm at an auction.
Yeah. The bank has to do the calculation to see what that interest savings is to the consumer, the buyer, and then that calculation may be $8,000, $10,000 that the seller then has to put up in order to buy the buyer's rates down.
Why would the seller do that?
We don't really see it in a normal...
He's like, we don't really know. It's really...
I'll give you...
No, I'm kidding.
I'll give you a great answer. I wanted to preface it by we don't really see that often in a normal market and in Southern Illinois. Where it does come into play is these mega home builders in metropolitan areas.
Selling Sunset, maybe?
Rather than dropping the price of a home from $300,000 to $250,000, and then that affects each sale that they have down the road, they'll entertain with the buyer, hey, we'll pay, we'll do a 2-1.
Get your rate down.
Yeah, we'll do a 2-1 buy down to buy your rate down for the first 2 years of your loan.
Okay.
And that way, the market price of the house stays the market price of the house. And the next guy that comes to buy a house, if he doesn't bring anything up about or negotiate his price, he still pays that higher price because the buy down doesn't get recorded anywhere. That's between the seller, the buyer, and the bank.
Interesting.
So that's where that buy down comes. And, the lenders talk to real estate agents to communicate to their sellers that, hey, if you've got some room there to look at, you may want to consider a buy down. That's an advantage to the realtor and to the seller because they can keep the home price up. But 99% of your home buyers don't have that kind of liquid money or equity in their home to be able to do that kind of a favorable treatment.
I'm going to buy your rate down.
It's usually it's in the builder markets where the builders want to keep their prices. If they're developing a subdivision, they don't want to constantly be dropping the price on the homes in that subdivision. They want to keep them all at that $300,000 price range.
Okay.
So they'll negotiate a buy down for different buyers because, again, that's behind the scenes and nobody knows about it.
Very cool. Do you feel like a real estate agent now, Jared? Jared's like dying to move to LA and be on Selling Sunset.
You guys could probably go past the real estate exam.
Can you see us on a billboard?
I don't even need to study. I do a podcast about it.
Exactly. The old Holiday Inn Express. Are you a doctor? No, I stayed in at a Holiday Inn Express. Are you a real estate agent? No, I listen to John Streuter's podcast.
No. Well, this has been so great, John. Is there anything that you else you want to share, or anything you want to listen?
Well, just what I always have talked about at the end of every podcast is make sure that you're dealing with a community bank, because you're not going to get this kind of service from the online companies. Rocket Mortgage isn't going to tell you about this. Rocket Mortgage isn't going to have your interest in mind. They're looking at what's the most profitable loan for them. They're not looking at the best value.
And they're a bunch of computers.
Right. And that more and more, they're even getting into AI. So, people need to realize that the more you deal online, you're not even dealing with a real person anymore in some cases. Some of these companies are using AI to generate all this up front.
Scary.
Crazy.
So deal with Farmer State Bank. And come see us, and we'll talk about this. We'll tell you when the right time is to refinance, and we'll tell you the best value in your mortgage. And because, as we know, the best rate is not always the best value. So
that's right. If someone wants to get in touch with you, how can they find you?
They can find me at what we call our West Branch in Marion, Illinois, by Walmart. They can also contact me by calling the phone number that I presume will be listed right below, and the email address that will be listed below.
Okay.
Perfect.
Thanks for being on here, John, for another mortgage market update.
Love it.
Thank you.
We'll see you guys next week. So, Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. We'll see you next week.
See you next week.